Right now, over $14 billion is fleeing the crypto markets. Investors are reacting to a digital bank run, liquidating positions as they watch red candles across the DeFi sector. But while retail traders are dumping their altcoins, Bitcoin is ignoring the chaos. Instead of following the market down, it is pushing past the $76,000 mark. This divergence is happening because institutional whales are building a multi-billion-dollar buy wall. They are acquiring supply while the broader market is distracted by the volatility. This reveals the first stage of an elite trade. For institutions, extreme market volatility creates a vacuum where assets are systematically transferred from retail panic into calculated long-term accumulation. The catalyst for this $14 billion exodus was a $290 million exploit of the Kelp DAO protocol, an attack orchestrated by North Korean state-sponsored hackers. Kelp is part of decentralized finance, or DeFi. It is a digital banking ecosystem run by automated code rather than human bankers, allowing users to earn yield on their deposits. This blueprint shows the vulnerability. Kelp DAO used a digital bridge called Layer 0 to move tokens. By relying on the bridge's default settings, they inherited a verification flaw in how the system confirms transactions. The hackers exploited this backdoor, tricking the bridge into authorizing fake transactions. This allowed them to siphon $290 million directly out of the Kelp vault. The fallout moved quickly. Aave, a major lending platform, is now facing $230 million in bad debt, while other networks like Arbitrum were forced to freeze assets to prevent further losses. While retail investors see this contagion as a systemic failure, elite traders recognize it as an isolated software bug, a localized event that provides the cover needed to buy blue-chip assets at a discount. The macroeconomic backdrop is also shifting. Traditional market fear is cooling as ceasefire talks between the US and Iran advance, causing equities to rally. The combination of easing macro tension and localized crypto panic creates the specific buy signal institutional heavyweights look for. MicroStrategy capitalized on this window by executing its third-largest purchase on record, acquiring 34,164 Bitcoin for $2.54 billion. To fund this purchase, the company is diluting its own perpetual preferred and common stock, raising capital to buy more Bitcoin while the retail market is selling. This is a sector-wide pivot. The treasury firm BitMine also made a move, purchasing 101,000 Ethereum for $230 million. The institutional strategy is consistent. Ignore the assets heavily exposed to DeFi contagion and aggressively move capital into pristine, blue-chip assets during the height of the panic. Following the whales into this Bitcoin pump creates immediate profit, but taking those gains triggers a specific tax trap within the updated IRS code. Beginning in 2025 and 2026, the government requires brokers to report digital asset sales directly to the IRS using the new Form 1099-DA. There is a critical issue with this new reporting. Brokers are not legally required to report your cost basis, which is the price you originally paid for the assets. Without cost basis data, the IRS will assume your gross deposits are 100% profit. This triggers ordinary income tax rates, which can reach nearly 40% for high earners. Without a defensive strategy, taking a profit on a successful trade can instantly turn new wealth into a significant government liability. High earners neutralize these crypto gains by utilizing the newly expanded 2025 IRS retirement contribution limits. The IRS has raised the base 401k limit to $23,500. For those qualifying for the new Super Catch-Up bracket, that limit increases to $37,750. To see how this works mathematically, imagine a W-2 salary of $100,000 and a short-term Bitcoin profit of $30,000. First, you take the $30,000 in crypto profit and move it to your checking account to cover your annual living expenses. At the same time, you divert $30,000 from your W-2 salary into a pre-tax 401k. Because these contributions are made before taxes, your taxable W-2 income drops to $70,000. When the IRS adds the $30,000 crypto gain to your $70,000 salary, your total taxable income remains at $100,000. You have secured your gains while completely neutralizing the tax liability. This is how the elite execute a trade. They ignore the media narrative during a panic, accumulate with the institutions, and use the tax code to protect the results.